Everyone wants to be the smartest person in the room. In the fast-paced, high-stakes arena of Wall Street, everyone is hunting for an edge, a hidden pattern, a secret formula to outsmart the market. But what happens when the voice you trust blindly is the very person setting the trap? Welcome to the Wealth Crime Lab. Today, we open the master case file on one of the most ruthless market manipulation schemes of the digital era. This is the untold story of Andrew Left, the fall of Citron Research, and how billions of dollars in market value could be completely manipulated by a single, calculated tweet. Human psychology has a dangerous vulnerability: the desire to belong to the elite. We see the flashing green and red lights of ticker symbols, and we feel a deep, burning urge to think, I want to be that smart. We want to believe that someone out there has cracked the code. Andrew Left understood this psychological trigger perfectly. He didn't just analyze stocks, he weaponized the public's desire for easy wealth. By projecting absolute authority, he created a gravitational pull that drew thousands of retail investors directly into his web, setting up a game where the rules were rigged from the start. Behind the polished TV appearances and corporate branding lay a brutal, predatory reality. According to federal prosecutors from the Department of Justice, Left described his scheme to his inner circle with chilling simplicity, stating, "It is like taking candy from a baby." These 8 words exposed the mindset of a financial predator. To Andrew Left, the thousands of hard-working retail investors who followed his advice weren't an audience to protect. They were a collective target to exploit, a resource to be mined for fast cash, wrapped in the illusion of independent financial journalism. For 2 decades, Andrew Left was considered the alchemist of Wall Street. As the founder of Citron Research, he carved out a powerful niche as an activist short seller. He wasn't just a face in the crowd, he became a mainstream media powerhouse. When Left spoke on CNBC or Bloomberg, the entire trading floor fell silent. He built his reputation as an aggressive watchdog, a fearless investigator who exposed corporate fraud and protected the public. But as federal investigators would later reveal, the grand illusion was that the watchdog was secretly running the biggest hustle on the block. In the modern financial landscape, traditional capital is no longer the ultimate weapon. Attention is. Through Citron Research, Andrew Left wielded a digital megaphone that could bypass traditional gatekeepers. He realized that a single tweet, formatted with the right amount of panic or hype, had the explosive power to wipe out billions of dollars in corporate market cap in mere seconds. It was financial warfare compressed into 280 characters. The public believed Citron was publishing independent, deeply researched market analysis. In reality, it was a highly efficient market-moving machine designed for maximum impact. To the outside world, Citron Research operated on an infallible, transparent formula. First, they presented a highly compelling research thesis, pointing out hidden flaws or explosive growth in a company. Second, they announced an extreme, eye-catching price target, a number so dramatic it was guaranteed to make headlines. Finally, Left would ignite the spark through a high-profile tweet or a live television appearance. It looked like legitimate, high-conviction investing, but the illusion was perfect. While the public focused on the distant price target, Left was already positioning his finger over the sell button. The true business model of Citron Research had absolutely nothing to do with long-term research. It was entirely about exploiting the spread. The spread is the predictable, violent price movement created by Left's own public announcements. Left knew with mathematical certainty that the moment his tweet went live, thousands of algorithms and retail traders would instantly execute orders, driving the price wildly in his desired direction. He didn't need his research to be right over months or years. He only needed the market to react for a few minutes, long enough for him to cash in on the chaos he created. The execution was a flawless, 3-step cycle of digital deception. Step 1. Broadcast the signal. Left would take a massive position in a stock behind closed doors, then unleash a highly sensationalized report to his massive following. Step 2. Reverse the position. As a wave of public buying or selling volume rushed in, pushing the stock price up or down, Left would immediately trade in the exact opposite direction of his own public advice. Step 3. Pocket the profit. Within minutes, the trap would snap shut, leaving his followers trapped in a collapsing trade, while Left walked away clean. To understand the sheer speed of this scheme, we look at the smoking gun in the federal indictment, the NVIDIA heist of November 2018. At timestamp 0, Left quietly established a long position and tweeted out to the world, "Citron buys NVIDIA. We see the stock hitting $165. The retail crowd rushed in, sending the stock surging. But the log showed that just 118 minutes later, less than 2 hours, Left quietly liquidated his entire position at $150. He pocketed $960,000 in pure profit, while publicly telling his audience to hold for a target that never arrived. This wasn't a one-time anomaly. It was a highly organized, multi-year criminal enterprise. Federal investigators from the FBI and the Securities and Exchange Commission meticulously traced Left's trading history between 2018 and 2023. The final tally was staggering: at least $21 million in illicit trading profits. $21 million extracted directly from the pockets of everyday investors who genuinely believed they were following a brilliant, transparent mentor. Every dollar of that jackpot was built on a foundation of deliberate, calculated market manipulation. But the conspiracy did not stop with Andrew Left. The web of deception extended deep into the shadows of institutional Wall Street. Federal prosecutors revealed that Left was operating in alignment with a network of shadow partners, corrupt hedge funds. Left allegedly gave these select funds advance notice of his market-moving reports before they were published to the public. This allowed the hedge funds to position their trades early, front-running the retail public. In exchange for this golden insider access, the hedge funds would kick back a substantial percentage of their trading profits directly to Left. Operating a multi-million-dollar illegal kickback scheme requires a way to hide the paper trail from regulators. To mask his illicit relationships with these hedge funds, Left turned to corporate forgery. Whenever a hedge fund needed to pay Left his share of the manipulated profits, Left would issue falsified invoices. Millions of dollars in illegal market manipulation payouts were deliberately disguised as standard consulting fees or independent advisory work. It was a calculated attempt to sanitize dirty money and hide a massive, systemic conflict of interest from the prying eyes of the SEC. While Andrew Left was celebrating million-dollar mornings in his luxury Florida villa, the real-world collateral damage was devastating. On the other side of every high-speed trade was a human being, a parent trying to build a college fund, a retiree protecting their life savings, a regular individual who watched an expert on TV and trusted him. When Left dumped his shares to lock in his fast profits, the artificial momentum instantly vanished, causing the stock price to violently crash. The retail investors were left holding a catastrophic loss, watching their hard-earned money disintegrate in real time. For years, Left believed he was completely untouchable, shielded by the anonymity of the internet and the freedom of financial speech. But in the shadows, a specialized forensic unit of the FBI and the Department of Justice was quietly building a digital fortress against him. This wasn't an ordinary investigation. It was a timestamp hunt. Federal agents utilized advanced data analytics to overlay social media metadata with microsecond accurate exchange logs. They matched the exact moment Left clicked tweet with the exact millisecond his brokerage accounts executed opposing sell orders. The digital footprints were permanent, and they were devastating. In May and June of 2026, the illusion of the financial watchdog officially dissolved inside a federal courtroom in Los Angeles. For 15 intense days, the United States government laid out its case. Left took the stand in his own defense, desperately attempting to convince the jury that his public statements were merely aggressive financial commentary protected by the First Amendment. But the prosecution systematically dismantled his defense piece by piece, presenting an overwhelming mountain of objective, data-driven evidence that exposed a clear, unyielding pattern of intentional fraud. The ultimate smoking gun presented to the jury was the stark, undeniable contrast between Left's private intent and his public statements. Prosecutors displayed internal chat logs and private text messages where Left openly mocked his own followers, laughing at how easily they could be manipulated to move a stock. The evidence proved beyond a shadow of a doubt that Left was actively hitting the sell button to exit his positions at the exact moment his face was on television, telling millions of viewers that the stock was a strong, long-term buy. On June 1st, 2026, the scales of justice balanced out. After intense deliberations, the federal jury returned a historic verdict. Andrew Left was found guilty on 13 major counts of securities fraud and running a criminal enterprise to defraud the public. The strike of the judge's gavel signaled the definitive end of Citron Research. It was a monumental victory for retail investor protection and a clear, thunderous warning shot sent directly across the bow of every financial influencer and activist investor operating on Wall Street today. The final page of the Citron Research case file will be officially written on August 31st, 2026. On that day, a federal judge will hand down the definitive prison sentence, drawing a permanent line in the sand for the financial industry. This upcoming judgment marks the absolute end of an era for unchecked social media market manipulation. It establishes a powerful, irreversible legal precedent. In the modern digital age, your online influence cannot be used as a weapon to deceive the public and manipulate the free market without facing severe criminal consequences. If the smartest voice in the room is secretly trading against the room, what is the true price of trust on Wall Street? How do we protect ourselves in an era where market manipulation is compressed into a single social media post? Leave your honest thoughts in the comments below. Thank you for watching this deep dive investigation by the Wealth Crime Lab. Make sure to hit that subscribe button, turn on all notifications, and stay tuned as we continue to dismantle the world's most sophisticated financial crimes. Stay vigilant and trade safe.